Hi there, welcome back to this series on how to find the best stocks that the Australian market's got to offer. And in the first video I looked at some of the key parameters such as return on equity, which is a really key driver of share price performance. And in this second part of finding the best stocks, I want to have a look at some really critical things. So I'm going to be looking at dividends, which to my mind is another real driver. It's a critical element. And we need to consider dividends relative to other forms of investment. We're going to have a look at why growth in dividends is actually so important. It's not just the dividend now, but it's the likely growth from year to year. And we're going to be comparing some high and low growth examples, which I think will really make it graphic for you. And also have a look at a ratio that's not looked at all that often, but it's equally important, and that's the payout ratio. We're going to have a look at debt. I'll give you a rough benchmark that I use. We'll also be looking at the price to earnings ratio and having a look at how you can actually use what's called the PEG ratio or the PEG ratio to best effect as well. So let's start with dividends. Now, you really ignore the dividend performance of a company at your absolute peril. Dividends make up a huge proportion of long-term wealth accumulation. And there was a study done by a company in America called Ibbotson and Associates that showed that nearly 50% of the total return from the S&P 500 stocks between the years of 1990 and 2010, so that's a 20-year period, actually came from dividends. So nearly 50% of it came from dividends. So when you're looking at buying something at the moment, it might be paying you a 4 or 5% dividend, and you might think that looks a bit boring, particularly when you don't need the cash flow. But just understand how important dividends are over the longer term. And it's really the growth in dividends that drives stock prices, and equally it's the predictability of the payment of those dividends, which is also really important for the market to assess. So let's have a look at dividends in a relativity sense compared to other forms of investment. So if you're getting a 5% return from a particular stock and it's fully franked, then that's probably a pretty good return when deposit rates are low. Now you've got some capital risk because you could lose some of your money on the capital side of it. But when you're comparing that with, say, interest deposit rates at 3%, which effectively has no risk, and you might be getting 7.5% or 8% after franking credits, then it's actually quite an attractive comparison. But what happens when interest rates move up to 5% or 6%, which is effectively with no risk? Then the stock that's paying 5% fully franked dividend becomes far less attractive. So it's always relative to other forms of investment. Now the payout ratio is also important. Most stocks are paying somewhere around the 30 to 60, maybe 70% payout ratio. Some stocks, however, are paying out nearly all their profits in dividends, which means that they've got very little wiggle room if anything goes untoward in their profits in the short to medium term. So it's always a good idea to be looking at stocks that have still got plenty of capacity to hold their dividends and even increase their dividends, even though they might have a period where, for short-term reasons, the profit may steady or it may in fact go down a bit. So you need to have a look at whether it's high or low. My preference is to try and look at stocks where the payout ratios are less than 50%. So let's have a look at a couple of examples, some high growth versus low growth dividends. Now, the low growth dividend ones that I'm looking at are basically big companies in their mature phase. So we'll have a look first of all at National Australia Bank. So over the last 5 years, National Australia Bank's dividend has actually gone from $1.94, it's actually gone down slightly to $1.83 per share. So there's actually been no growth. It's been effectively flat. So with inflation, that means that you're actually slightly going backwards. Now, the growth in Wesfarmers dividends has been pretty good, and I've chosen some of the better low growth stocks, if you like, but even so, the comparison is still very stark. So Wesfarmers dividends have grown by about 50% from 93 cents a share to $1.33 over the last 5 years. And that's pretty useful. Next is Woolworths, and ironically their dividends are exactly the same as Wesfarmers. And then of course BHP have also grown their dividends by roughly 50% in that period of time. So somewhere around about that 30, 40, 50% growth over a 5-year period is pretty typical of larger stocks. Now let's have a look at some stocks in their high growth phase. MTU in the telecommunications sector has increased their dividend by 400% in that same period, from 5 cents to 20. Credit Corp has gone from 4 cents to 37 cents, a huge rise. That's up 900% in that period of time. iiNet, another stock in the telecommunications space, has almost tripled their dividend in that period. And Monadelphous, a really well-established and incredibly reliable financial performer, has doubled their dividend during that period of time. So there is a huge, huge difference in the growth rates of the dividends between growth stocks and the mature stocks. Now let's move to debt. A reasonable benchmark for debt is that the company has less than 50%, or the debt represents less than 50% of shareholder equity. I also look at something called interest cover, which is how many times the net profit covers the interest on the company's loans. 2 times is an absolute minimum for me. So if the company's paying out, let's say, $1 million a year in interest on its loans, I would want to see an absolute minimum net profit of $2 million. But preferably I'd want to be seeing 6 to 10 million profit. So I want to see 6 to 10 times the level of interest payments on the loans, just to have plenty of capacity to, again, just absorb the ups and downs in the running of the business. Now let's move to the next important parameter, and that's price-earnings ratio. Now it's calculated as the share price divided by the net profit per share. So just to repeat that, the share price divided by the net profit per share. Now different sectors of the market tend to trade within different bands. Banks, for instance, tend to trade within the bands of a PE ratio of about 8 or 9 when things are really cheap, up to maybe 12, 14 or 15 when the banks are really a bit expensive. So they tend to stay within that range pretty much the whole time. Whereas if you look at healthcare stocks, for instance, they tend to trade in the range between around about 20 times and maybe 30 times. So the market is prepared to pay a much higher multiple of earnings to buy a healthcare stock than it is, let's say, a banking stock. Now the average as a whole for the whole market is around about 15 times. So that's about the midpoint. So it's important to have a look at the relativity to historical bands when you're looking at a particular stock and that particular sector. And of course, it's also important to look at PE ratio in relation to the future earnings. If the future earnings are going to continue in a fairly robust way, then you don't mind paying a higher multiple for that increased growth. Now let's have a look at some of the limitations on using the PE ratio, because it is a very coarse measure. It's driven heavily by perceptions of future earnings, and there's a lot of assumptions that go into that, and it says absolutely nothing about the actual cash flows today. So PE ratios are useful, but they're a broad brush measure, and they do need to be applied in context. So don't get too carried away with a single figure. Now just moving to the PEG ratio, it's calculated by taking the PE ratio and dividing it by the growth in the earnings per share. So ideally you want it to be less than 1. So if the company's trading on a price earnings multiple of 15 and its earnings are growing at 15%, then you're going to get a PEG ratio of 1. It's better to have the growth in earnings to be greater than the actual PE ratio. So if the PE ratio is 15, it'd be great to have the stock growing their earnings at 20 to 25% per annum. So that would give you a PEG ratio of less than 1. So it's a useful guide, and obviously the lower the better. So they're the key parameters that you need to look at when identifying the best stocks that you can find. But as I said in the first video, it's important to look at consistency and reliability results equally as much as looking at the absolute results themselves. Now, the topic of fundamental analysis is a big one. Let's have a look at what you need to do it properly. The first thing is you need to do plenty of consistent research, and that takes time. And it's got to be regular. This is not a do it once and move on, forget about it. It's constant, it's ongoing, because things are changing and volatile. And to apply yourself to do that, you've really got to have the passion for it. And that's a really important criteria. So unless you're prepared to put in the time regularly and you've got a real passion for doing this sort of thing, this sort of number crunching, then you're better off perhaps getting someone else to do it for you. And that's really the realistic approach for most people, in my view. Now, in the next video, I'm going to be looking at the best shares to invest in. We're going to be looking at the methods that Warren Buffett uses to value stocks. Look, I love all this stuff. I've been doing it for 30 years, and I've put out a lot of free information which you can access at our website. So if you'd like me to send you a weekly update, then just fill out the form on the site. This weekly update outlines the key things that are impacting our market, plus a strategy overview. I'll also send you videos teaching my key principles of creating consistent profit and longer-term wealth. I really want you to gain a big edge on the market and on everybody else. So click on the button on this video or in the description below and join in with our community of traders and investors. Cheers for now.